So, as Ben mentioned, I'm a partner at Clyde & Co. Solicitors. For those of you that don't know us, we're one of the leading law firms in professional liability disputes. I personally spend a lot of my time working with firms of surveyors, helping them deal with troublesome practice matters that they encounter. And through that, we get a pretty good view of what goes on in the market generally. Now, I'm going to start with a bit of a plug, which is for the new RICS guide on risk, liability and insurance in valuation work, published just a few weeks ago in late January. I had the pleasure of being one of the contributing authors to it, but nevertheless, I would still encourage you to have a read. It contains some important guidance relevant to all parts of day-to-day practice for all of you. I wouldn't limit the readership of this to more senior members of teams who are dealing with client engagements, terms and conditions, etc., on a regular basis. For everyone, the themes and the subjects dealt with this are really important, and the sooner that everyone can get to grips with them, the better for all concerned. So what's it all about? Well, it starts by setting out some text on the approach taken by the courts to valuers' liabilities. That covers issues relating to breach of contract, negligence, the concept of the bracket or the margin of error, which is what the court uses when assessing whether a valuation is negligent. And it sets out some information on the time limits for bringing claims, etc., etc. Then the ever-important issue of liability caps. The guide sets out some of the key considerations which need to be borne in mind when you're setting caps on your engagements. In particular, it identifies the main factors that the courts will consider when deciding whether a liability cap should be upheld. Those are principally the level of risk that you're taking on the engagement, the level of fees that you're charging, the level of your PI insurance, the potential liability that you may incur if you weren't to benefit from a liability cap, the degree of sophistication of your firm and your client organisation or individual, and the relative bargaining positions of each of the parties, and importantly, how effectively the liability cap is brought to the attention of the client. The guide then sets out some thoughts on third-party reliance on valuations. This is a really key risk consideration and something that's very high on the agenda for many firms and for the RICS at the moment. You can get into all sorts of difficult issues about whether third parties who are permitted to rely on your valuations are bound by your terms and conditions, in particular those liability caps. The ideal would be to have a pre-agreed terms and conditions with that third party who's relying on your report before they see the report. But I know, and you will all know, that that's rarely possible in practice. So the question is then, how do you achieve those protections? The answer is to make sure that as much is done as possible to ensure that the person reading and relying on your report does so in the knowledge of the terms on which they're doing so. So all sorts of disclaimers and flags flying in the report and in any reliance letters are absolutely essential. On PI insurance, the guide discusses issues relating to the level of PI insurance which firms will need to obtain, aggregation of claims, the claims made basis of PI insurance, uninsured excesses, the requirements for run-off insurance, etc. And then there are some, I've just realised I've skipped over contract terms. That just deals with some of the other terms of engagement apart from liability caps, things like scoping out your engagement properly, making sure you exclude personal liability for individual valuers, including proportionate liability clauses, which can be very important indeed. So jumping back down again, the appendices, this is probably the biggest change in the structure of the guide compared with the last version. They set out some sector-specific issues in relation to residential valuations on the one hand and commercial valuations on the other. And also there's another appendix dealing with dispute resolution mechanisms. Most cases don't get resolved through the courts. Most of them get resolved through generally mediation or negotiation or other forms of alternative dispute resolution. And having an understanding of how those systems work can be quite useful. So, as I say, it's an important document, sets out information which every valuer should be familiar with as part of your day-to-day practice, and I would commend it to all of you to have a read when you get the chance. Now, with that over, I'm going to move on to the legal update part of my talk. The claims landscape for valuers remains pretty benign, which is good news for all of you. There are very few new claims being brought at the moment, but there are some warning signs out there, and Simon mentioned some of the economic warning signs. Valuation claims tend to follow with a bit of a time lag after changes in the economy. Normally it starts with a deterioration in the quality of lending practices, and this headline on the slide from a few weeks ago should give all of us a bit of a cold chill. If the CEO of Barclays is telling Davos that it feels like 2006 again, we should all be very afraid indeed. Now, there were a few valuation cases which went through the courts in the last 12 months. The most high profile of those was the Toyota and De Villiers case. Those of you who heard me speak at this conference last year may recall that I was a little bit scathing about the Court of Appeal judgment in this case. I'm going to try not to sound too smug when I say that the Supreme Court, in a 15-paragraph, very short judgment from Lord Sumption, has proved me right. This was the case about whether a valuer who was valuing in relation to an extension of a loan, sort of a top-up loan, could be held liable for losses attributable to the original loan. The final outcome in the Supreme Court was that the assessment of the losses which the lender could claim against the valuer had to take into account the extent to which the lender was already exposed in relation to the transaction at the date of the second valuation. So this meant that, in effect, the claim against the second valuer was capped by reference to the amount of the top-up loan, not taking into account any of the original lending. To my mind, and as I said last year, that had to be the right answer, because to do otherwise would overly penalise the valuer. But the interesting points which come out of this case, and the reason why it got as far as the Supreme Court, they relate to the headaches which can be caused for claimants in this situation. So let's assume that a lender advances a loan in reliance on a valuation which, unbeknown to the lender, is negligently high. The lender then, a few years later, makes a further advance to the same borrower in reliance on a second valuation, which is also, again, unbeknown to the valuer, to the lender, negligently high. The problem that the lender can face there is that there is a Supreme Court authority which says that in most scenarios, the way in which these things are structured, the second loan acts as a full repayment of the first loan. So that means that a claim against the first valuer can't succeed, because the first valuer can say, well, you got your money back because your first loan was repaid because you did this further transaction. But then the Toyota case says, against the second valuer, you can only claim the top-up amount, not the original amount. So potentially, losses attributable to that first loan could fall into a black hole. Now, what the Supreme Court suggested as a possible way around this was maybe for the lender to sue the second valuer on the basis that their negligence in overvaluing also, as well as causing the lender to advance more money, prevented the lender from taking steps to recover the original loan, for instance, taking steps to sue the original valuer. That might work in theory. In practice, could be very complicated indeed, because then you'd be getting into all sorts of difficult loss of chance issues. You'd have to be assessing the value of the claim against the first valuer, how that claim might have been settled, perhaps, maybe at a mediation, how much the costs would have been incurred, what sort of discount might have been agreed on the claim, whatever it may be. All sorts of imponderables, but all good from my perspective and from the perspective of all of you as well, because these are problems for claimants and good points for defendants to raise if they need to do so. The other Supreme Court case last year, which is relevant to the valuing profession, is Hughes Holland and BPE. Now, this was a claim against a firm of solicitors, but it raised issues in relation to the Samco cap. Those of you who know about value liability and the case law on it will may be familiar that Samco says that a valuer, effectively, the maximum that can be claimed against a valuer is the difference between the value reported and the true value as at the valuation date. It's all to do with the scope of the valuer's duty and the role they take on in the transaction, and not making the valuer liable for losses attributable to a crash in the market, which wasn't foreseen at the valuation date. The outcome, insofar as you are all concerned, of the Hughes Holland case is simply that the Samco cap remains unaltered. There was an attempt to try and get it overturned altogether. That failed, and so the position remains as I just explained. Next was Bank of Ireland and the Watts Group. Now, this was a claim against a monitoring surveyor in relation to its advice on a development costs estimate for a property development project. The point which is of interest to us here today is that it relates to the court's finding on negligence. The court found that the surveyor was only engaged to carry out a high-level overview exercise and not a full-on in-depth review of the costing which had been produced by the borrower in this case. The court drew a clear distinction between the fees which the surveyors had charged, £1,500, and the fees charged by the claimant's expert in trying to prove that the surveyor had been negligent, £24,000. So the court found that the surveyor's duties were limited by reference to the scope of the retainer, and on the basis of it having been a broad brush overview exercise, the court found that the advice that had been given was competent. There have been a couple of other cases on a similar theme recently, but reaching differing conclusions. At the more helpful end of the spectrum, as far as we're all concerned, and in keeping with the Watts case, was the Thomas and Hugh James decision. That was a claim against a firm of lawyers. They had been acting on a piece of litigation, a personal injury claim, for a fixed fee of £607. The court held that in those circumstances, they weren't required to turn over every stone when investigating the facts surrounding the dispute. So a limited duty by reference to the limited fees that they were charging. But completely the opposite end of the spectrum, the Burgess case, there the defendant was liable even though she didn't charge a penny for the services she provided. She was providing some, I think it was landscaping design services to her next door neighbours, sort of as a favour, but also with a view to getting a retainer from them for a bigger project they were planning. But she was held liable despite the fact that she didn't charge any fee whatsoever. So it seems that no good deed goes unpunished. Now, what could this mean for all of you? Could it mean that, for instance, where a valuer charges a modest fee, perhaps the margin of error or the permissible bracket of valuation should be wider? There would be some logic in that. It would be consistent with the court's findings in the first two cases, the Watts Group and the Thomas and Hugh James case. But I don't think that's ever likely to happen. Certainly not where you're instructed to produce a Red Book valuation. In those circumstances, I think that the court would insist on going through all the steps you always go through on a Red Book valuation, carrying out the due diligence you have to do in order to identify relevant evidence, analysing that evidence and applying it to the subject property in the normal way. These authorities might be useful if ever there were to be a circumstance where a claim relates to something other than Red Book valuation, something of a lesser degree of diligence, a desktop valuation, for instance, or some sort of indexation exercise. In those circumstances, you ought to be able to argue that you would have a more limited scope of duty, and so the standards that you have to meet in carrying out those tasks are lesser. But having said that, you'd hope that no one ever would rely on a desktop valuation or an indexation or anything of that sort, and so shouldn't be suffering losses because of them. I certainly have never seen a claim in relation to that sort of job, but it's there if it's needed. Now, the final case I'm going to talk about today is one of mine. We acted for CBRE in relation to the defence of a claim brought by the Dunfermline Building Society. This was a claim relating to the valuation of a residential development site, which was done in spring 2007. CBRE valued the site at £17.5 million, and that was the price which the borrower had agreed, subject to contract, to pay for the property. That was an off-market transaction, so it was argued that the purchase price was of limited relevance to the valuation exercise. But the borrower was no mug. It was AIG's real estate arm and in joint venture with a small house builder. So we were able to say they knew perfectly well what they were doing and that the purchase price was good evidence of value. Nevertheless, our opponents thought they had a good case and took it all the way to trial, which is quite unusual. But that proved to be a bad decision for them because we succeeded, the claim failed, and they're now having to pay over £500,000 towards CBRE's costs. The first point that I want to mention about this was about the type of property in question. As I mentioned, it was a residential development site, so the valuation was a residual valuation, as is always the case for that sort of property. In my experience, these are the riskiest types of valuation. They produce a disproportionate number of claims and disproportionately high value claims as well. That is mainly because of the amplifying effect, which you'll all be familiar with, where small changes to the inputs into the valuation create large differences to the final answer. That means that the valuations can be easy to get wrong, and that getting them wrong can have dire consequences. So these should be highest on the risk register for all of your firms, and should get the highest degree of scrutiny and supervision when they're carried out. In terms of risk profile and sort of a hierarchy of risks, after residual valuations, I would put trading property valuations. You see quite a few claims coming through that relate to those, usually in relation to more unusual types of properties, things like care homes, holiday homes, whatever it may be. The problem that we often see in that area is usually attributable to a lack of real sector expertise from the valuer in question. Somebody who's just having a bit of a go and a bit of a dabble. Traditional investment valuations are relatively low in terms of risk profile because there are fewer things that can go wrong with them. But the much greater number of investment valuations which are carried out means that they still generate, or historically have generated, large numbers of claims. The next point to draw out from the CBRE case relates to the court's approach to the valuation process. Now, for those of you who aren't familiar with litigation, I can't stress enough that it is nothing like real life. The valuation, which is the subject of the claim, may have been carried out in the space of a few days for a relatively modest fee. But if something goes wrong, we will spend hours poring over every single detail of it, interrogating it to the nth degree, and looking at all of the surrounding evidence and carrying out research probably far in excess than is realistic to expect valuers to do on a day-to-day basis. To illustrate, in our case, the valuation report was 41 pages long, minus appendices. Our expert report, 111 pages long. Now, some of that was taken up with explaining to the judge the valuation process, noddy guide. But the majority was in-depth, detailed analysis of every little bit of valuation evidence available to us, where we scrutinised and questioned every last point. Now, I spent quite a lot of time in a number of valuation firms over the years, and I know that in reality this isn't how it works every single time. But the point is, where a claim is made, those are the standards that you are judged by, unfair though that may be. Now, the reason that we take this forensic approach when we're dealing with a claim in relation to a valuation is that although the courts have recognised repeatedly that valuation is an art and a science, they don't really much like the art bit. They much prefer the science. So the aim is, when presenting a case for trial, is to try to justify and explain every decision that the valuer has made along the way by reference to hard evidence and a clear, cogent analysis of that evidence. Valuer judgment has to be exercised, and the courts recognise that. But what they want to see is it exercised in a coherent way, which links back to concrete facts and not just broad brush feel for the market or anything of that sort. Another aspect of the unrealistic degree of scrutiny that can be imposed in the litigation process is the analysis of the valuation file. As in almost every other case, in this one we were put through a blow-by-blow interrogation of the valuation file, looking at every single email, every manuscript note, every annotation in order to piece the story together. Now, it happened to be that we didn't actually have any witnesses of fact in this case, which is quite unusual, but that meant that if it wasn't written on the file, we couldn't prove it. So we just had to rely on the file to evidence the level of diligence that was carried out by the firm when doing the valuation. The claim probably wouldn't have got anywhere near court if we'd had a much more fulsome file which showed the steps that were taken in terms of collating, analysing and applying the valuation evidence. So what does that all mean in practice? I know that in the real world it's rarely possible to write everything down and get it on the file. The key really has to be to try and identify those most significant points and facts that you deal with in the course of a transaction, and get them onto your file somehow. Send yourself a quick email, because if it's on email, we will find it eventually, just to get it onto the system so that we can get there if we need to. Insofar as the valuation analysis side of things is concerned, just bear in mind that those broad brush judgments based on unspecific market knowledge don't cut it in court. The more analytical the valuation is, the better its prospects of withstanding scrutiny down the line, and the easier it is for the reader to see how the valuer collated their evidence, analysed it and applied it, the easier it is for people like me to defend that valuation if it's necessary to do so. Next, I wanted to talk about purchase price evidence. I mentioned before that our case was a valuation where they valued at purchase price. Purchase prices can either be your saviour or your downfall, but it seems to me that the scales are tipped in one particular direction. A valuation at a level higher than purchase price is very difficult to defend indeed. A claimant lender will say with some degree of force that the fact that the borrower has agreed to pay X for a property is conclusive evidence that a valuation at X plus 20% is too high. But you shouldn't assume that valuing at purchase price makes you bulletproof. As I say, our case was a valuation at purchase price. We still ended up in court arguing about it. The purchase price was 17.5 million. The judge concluded that the true value of the property was 16 million. Our valuation was well within a reasonable margin of error from that figure, so we were not negligent. But it was clear that the judge didn't feel that he should place too much weight on the purchase price evidence. Now, courts can sometimes struggle with how to deal with purchase prices. They recognise the valuer can't just adopt a purchase price blindly, otherwise there'd be no need for the valuation profession at all. But the question then arises as to what role the purchase price should play in the valuation exercise. The judge's view was that he should carry out his residual appraisal and then compare the results of that exercise with the purchase price, the stand-back test, which is clearly the right way of doing it. His residual appraisal came out at 16 million. He didn't actually do the figures himself. He just got there by deduction from what our expert had said. He then said that his view was that some weight should be given to the offer price as a check on the residual appraisal of the property to confirm that the property's residual land value is not excessively high. But the offer price should not be given so much weight as to cause the property's market value to be higher than its residual land value as I have already determined it. So, as I say, he's stuck at 16 million as per his residual calculation. Now, to my mind, that was an understatement of the importance of purchase price evidence. It would have taken very little adjustment to get from the 16 million figure residual calculation to the 17.5 million pound purchase price. And in the real world, if the valuers had reported anything less than the 17.5 million purchase price without some clear indicator that there was something wrong with that purchase price, I can imagine that there would have been lots of toys thrown out of various prams, and by hook or by crook, the borrower and the lender would have ended up with a valuation at 17.5 million, the purchase price level. So, again, litigation is nothing like real life. The answer must be to avoid it at all costs. The practical point which comes out of all of this is that if you're ever contemplating valuing at higher than a purchase price, stop and think about it. Think a couple more times about it, maybe sleep on it, maybe talk to some colleagues about it, and then don't do it. It's a terrible idea. It makes life very difficult for all concerned. But by the same token, you can't rely slavishly on purchase price evidence, particularly if it's an off-market transaction. Even the most sophisticated investors can get it wrong from time to time, and your role, partly, is to protect your clients against those sorts of events. Another feature of the CBRE and Dunfermline case was the sensitivity analysis at the end of the residual appraisal. At a late stage in litigation, we identified that our opponent's expert had made an error in his sensitivity analysis in the table he set out. Instead of making adjustments in steps of 2.5% and 5%, he'd actually adjusted the gross development value and the costs by £2.50 and £5, which is a much smaller proportionate adjustment. We put this to him in cross-examination. He went away, redid the analysis, and came back with a revised table. That caused him to have a fresh look at his figure and actually to move his valuation upwards in the course of his cross-examination So while we were there in court, the figure ended up being a hair's breadth away from where we needed it to be in order for us to face no liability at all. The main practical point to come out of this is that it seemed to us that our opponent's expert hadn't really used his sensitivity analysis as part of the valuation process in the way that I thought he should have done. He did ultimately concede that he should have used it as part of his stand-back test and in reflecting on his figure, and that was what caused him to move his valuation up when he was shown the correct sensitivity analysis. The important point to bear in mind is that the sensitivity analysis is not just there to tell your client this is what happens if you make small changes. It's there to help you get to your answer. And I actually think it's in the wrong place in the report. I think it should come before you get your market value rather than after, because it is part of the process of getting to your final figure rather than just something that should come afterwards. Now, finally, the last part of my talk today is intended to try and bring to life some of the themes that I've been talking about, some of the points which are discussed in the RICS guidance note, and the points that you'll hear about from your own internal risk management teams all the time, I'm sure. We brought a film crew in to the office and set up one of our meeting rooms as a courtroom for the scene of a mock cross-examination. The cross-examination relates to a scenario which we put together based on facts from real-life cases that we've handled recently. We changed the names and some of the details so as to protect the innocent. We had one of my associates, Claire Curtis, playing the role of the valuer accused of having been negligent. Lucy Coulter, who is a barrister at 4 New Square Chambers, specialising in professional liability disputes, currently holding the title of Star of the Bar, very kindly took the role of the claimant's barrister cross-examining Claire. And because I came up with the idea, and because I paid for the film crew, I got to be the judge. And we've edited the footage down to a few short clips, which I'm going to play for you now. And we'll start, hopefully, with a bit of scene setting.
Ms. Curtis, you were a senior surveyor at the time of the valuation, is that right?
Yes.
And Mr. Conster was a director of considerable experience.
That's correct.
And Ms. Siobhan Neal was a graduate surveyor.
Yes.
And had she ever worked on a valuation like this before?
Not with me, no. Possibly with colleagues, I don't know.
You would have known, wouldn't you, if she had been involved with a valuation of anything like this scale and complexity?
Not necessarily. I mean, she could have done work for one of my colleagues, I say.
Ms. Curtis, you would have known, wouldn't you? Almost certainly, if she had done some work like this before.
Maybe more likely than not, yes, but I can't say for definite.
And the timing of this particular valuation was very inconvenient for you, wasn't it, Ms. Curtis?
I don't follow what you mean.
Well, you were due to be on holiday.
Yes, I did take some holiday at the end of the month, yes.
You took a week. You were away from the office for a week.
I believe that's correct, yes.
During which time you did no work on this valuation at all.
Did some work before I went away, yes.
Well, you hadn't received the instructions before you went away, Ms. Curtis, had you?
But it was right on the cusp of when I was going away.
On your last day of work, you received some instructions?
Yes, that's correct, yes.
So the reality is you did no work before you went on holiday?
No, I spoke to the bank who had instructed us to prepare the valuation and had some preliminary discussions with Mr. Conster and with Ms. Neal. So yeah, I did do some work.
We don't see the notes of any such discussions, do we, on your file?
No, regrettably they're not on the file, but they did take place.
Well, I suggest that if anything, you had some generalised conversation about the valuation, nothing more.
We definitely had conversations. I can't remember the exact details now. It's a long time ago.
And that in fact the only work you did on this valuation was on the 2nd and 3rd of July after you returned from holiday?
No, that's not correct. I did more than just that. I know it looks like it from the papers, but I did a lot more.
So that's scene one. We have Ms. Curtis as the valuer. She's supposed to have day-to-day conduct of this instruction. She's supervised by Mr. Conster, the senior surveyor, and she was supervising a graduate by the name of Ms. Neal, who's our trainee, by the way. The claimant has established that Ms. Neal had little experience of valuations of this sort, and they've also made the point that Ms. Curtis was away for a week in the critical period while this job was being done. And we had some awkward exchanges at the end about the discussions which Ms. Curtis is sure took place, but which aren't recorded on the file. Let's see what happens
next.
next.
Let's look at your view of this valuation, Ms. Curtis. Can you go to page 354, please, behind tab 2?
Yes.
And down, 2/3 down the page, value of site with outline planning. Do you have that?
Yes, I do.
And what you've put here is value of site with outline planning, 130 million, brackets 25 million and £350 per square foot.
That's correct, yes.
Yes, and if we turn on a few pages, this is your email to Ms Neil just before your holiday.
Yes, that's correct.
And you say again, the site value is 25 million, 130 million GDV.
That is correct as well, yes.
Yes. But you haven't carried out a valuation at this point, have you, Ms Curtis?
No, it was just initial thought on the valuation before. It's not a final valuation, obviously we go through those steps.
Well, it's very plain, isn't it, Ms Curtis, that even at this stage you had already taken a firm view on what the value was going to be in your report.
It might look possibly like that, but that isn't the case.
Ms Curtis, that figure of 25 million, was that based on anything? Was it just a figure you pluck out of the air? Did someone mention it to you? I mean, what does it represent?
It's the number that I knew that the purchaser was prepared to pay for the site.
Right. So you've been told at this stage, right at the outset?
Yes, I was told that information.
The purchase price.
Yes, my lord.
And it's fair to say, Ms Curtis, from that point on, you were just going through the motions, weren't you?
No, that's not correct. We went through all the normal stages of full valuation. There were no corners that were cut.
Well, if this hadn't been your view, Ms Curtis, you would have written purchase price in your notes, wouldn't you, not value?
I appreciate the wording. It is regrettable. I didn't phrase it as well as it should have been, but it isn't the case.
The truth, Ms Curtis, is that you had no intention of coming to a value of anything other than the purchase price.
That's not correct. I assure you, it really isn't correct.
So from that exchange, we can see that the claimant is able to assert, based on the file, that the valuation had been predetermined by reference to the purchase price, and that everything thereafter was just going through the motions. Ms Curtis is adamant that that's not how it worked, but the claimant has seized on the opportunity to put a spin on what can be seen from the documents. Now we get into some real drama in the next section.
Can we go to page 352 of the bundle, please?
Yes.
And this is an exchange of emails between you and Thomas Blanco.
That is correct.
Who is Thomas Blanco, Ms Curtis?
He's a contact at a Build-A-Lot.
And how do you know him?
Thomas and I go back a long way. He used to work at our firm with me and with Mr. Conster.
You mentioned contact at Build-A-Lot. Can you remind me what their role is in this?
Yes, Build-A-Lot is actually the borrower in the transaction that was going to happen.
My apologies, thank you.
Yes, my lord.
Thank you, my lord. So your contact at the borrower, we see from this email, you suggested lunch to him on the 2nd of July.
I did, yes. We hadn't seen each other for a while. So.
And what did you discuss at that lunch?
Several different things. We spent some time catching up, and we also briefly discussed the transaction that was going to go ahead with the property and Build-A-Lot as the borrower.
Had you told the bank that you were going to meet with the borrower?
I don't remember whether I mentioned it. I just can't remember.
Well, let's look at page 461, because this is a private email, Ms Curtis, between you and Ms Neil.
Yes.
About your lunch with Mr Blanco.
Yes, that's correct.
You complain about the fact he's an arrogant something. What's the something, Ms Curtis?
I prefer not to say. It's not a very complimentary word, and I'm embarrassed I used that language there.
And what you tell Ms Neil is that he was banging on about what an easy valuation it is given the purchase price and pushing me to say what we were going to report at.
That's correct. That's what I put in my email, yes.
Did you tell Mr Conster about this?
I don't recall whether I did.
And you certainly didn't inform the bank that you'd had this meeting with Mr Blanco?
Again, I just don't remember.
So this is a secret meeting between you and Mr Blanco at which he puts you under pressure to value this property at the same as the purchase price. Is that fair?
There was certainly he did talk about it. He had quite a strong view about it, but I didn't succumb to any pressure. I mean,
immediately after your secret meeting with Mr Blanco, you had a catch-up with Ms Neil at 3:30, is that right?
I did, that's correct.
Yes, and that was the meeting at which you decided that the value was indeed going to be the same as the purchase price.
It just happened to be the same as the purchase price. It's a mere coincidence.
A mere coincidence, Ms Curtis?
Yes.
You've just met secretly with an individual who's told you that the valuation ought to be the same as the purchase price, and and you've done exactly what he told you to do.
It's just a coincidence. That's the valuation. That's the value we arrived at. It's just coincidence. It's the same.
It's coincidence that you did almost no work on this valuation and happened to come up with the same figure as the purchase price.
Yes.
That would be an extraordinary coincidence, wouldn't it, Ms. Curtis?
Yes.
I suggest you did exactly what he told you to do.
I didn't.
So there we saw some clear evidence that the valuer had come under pressure from the borrower. I know these things do happen in real life. Parts of the story enabled the claimant to be able to say that the valuer did succumb to that pressure. The fact that the valuer was having private discussions with the borrower about the valuation without informing the client would not go down very well in court if that ever were to come out. We also had the email exchange with some inappropriate language used to describe the borrower. And we all have those sorts of thoughts from time to time. Just don't write them down, because we will find them, and you don't want them to be revealed if it comes to it. And then we had more evidence that the valuation was predetermined rather than having been the result of a proper analysis. So now our final scene.
Ms. Curtis, can I take you to page 160 at tab 3, please?
Yes,
This is the All Right Estates report, isn't it?
that's correct.
And can you tell my lord who commissioned this report?
This was commissioned by the borrower, my lord.
And in it we see 5 comparables referred
Yes.
to, don't we?
Yes,
Have you ever read this report, Ms. Curtis?
I have.
What we see in Ms. Neal's notes to you on the 2nd of July is that she says this: average sales suggested by All Right Estates are £350 per square foot. They have given us some very good comps.
That's
Do you remember
correct.
that comment?
I do, yes.
And what she meant by that were very good comparables that fitted with the answer you wanted on valuation.
No, that's not correct. That's not what was meant there at all.
Because all that Ms. Neal does, Ms. Curtis, is simply put those comparables into your report.
They were comparables that were used in the report, yes, that's correct.
There's no evidence of any independent analysis on your part at all, and yet you saw fit to simply plug these figures into your report. And that meant, didn't it, Ms. Curtis, that they were unreliable because they were guesses or predictions?
Well, they were looking ahead. They weren't a formal valuation.
No. And as a result, Ms. Curtis, the figures in your report were simply far too high.
That's the value that we thought for the property. I don't agree they're too high.
But where's the independent analysis? There isn't any, is there?
There is. It's our independent analysis. We considered it.
Who's we? You and Ms. Neal?
Mr. Conster.
Are you telling my lord that Mr. Conster put his mind to these comparables? Is that your evidence?
Maybe not in the micro level, but we did have discussions about how we reached the valuation.
He didn't look at the All Right Estates report, did he?
You'd have to ask him. I don't know. Whether
Not
he
to
did.
your knowledge, Ms. Curtis.
No, not to my knowledge. No.
Shall we look at the construction contingency? You reported a construction contingency of 10% of the main contract cost, yes?
That's correct.
And take it from me, that should have been a figure of 8 million.
Okay.
And your report referred to a figure of £150,000.
That's correct.
And that's not 10% of anything, is it?
No.
And where did that figure come from?
From our calculations.
Whose calculations, Ms. Curtis?
Those calculations were done by Ms. Neal.
Yes, and you didn't check them.
I did check them.
Well, you can't have checked that one, or you would have spotted that obvious error, wouldn't you?
Just a human error. It's just an oversight. That's all.
But you didn't spot even the obvious errors in this valuation, did you?
I just happened not to see that. That's all.
And that's because you just weren't spending the time on this valuation that was required.
I did spend the time.
You were rushing, Ms. Curtis.
It was time pressured. Yes.
You already knew the overall figure.
No.
And you weren't doing any detailed analysis whatsoever.
I did do detailed analysis. As I said, it was just a coincidence that the figure was the same as that was the purchase price, nothing more.
If you had done detailed analysis, Ms. Curtis, we would see it on the file, wouldn't we?
I appreciate the file doesn't give the true, complete picture. More happened than what's on this file.
Well, I suggest no more happened than it's on the file.
No, that's not correct.
And in fact, you simply didn't spend the time on this valuation that was needed.
I did.
So we end with the evidence that the valuers didn't apply any independent judgment but instead cut corners by relying on research commissioned by the borrower. The file didn't contain any evidence of the valuers having carried out any analysis of their own, and so the claimant was able to make out a case that the valuation was not prepared with due skill and care. We also had an arithmetical error in the calculations perpetrated by the graduate, which the surveyor didn't spot. That gives a clear inference that the graduate was out of her depth and not properly supervised, and again, that the job wasn't done with the requisite degree of skill and care. Now, as I said at the outset, these facts are all taken from real-life cases, and I hope that the video gives you an idea of the importance of not just the final answer in your valuations, but the process you go through when getting to it, and in particular, the way in which the contents of a file can be manipulated by very clever claimant lawyers in order to portray a picture that they want to put forward in order to undermine the competency of the job that you've done. I also hope that the video gives you a bit of insight that helps you avoid getting into any sorts of situations of that type yourselves. That's it from me.